Before we get into this special deal review episode, here are the required disclaimers that remind you that all investments carry risk and that none of this commentary is intended to be financial, tax, or legal advice. This program is intended to display how experienced LPs analyze a deal and question a sponsor. Now let's get to it.
Hello, passive investors. Welcome to Passive Pockets presented by Equity Trust. I'm Paul Shannon, your host for today's exclusive deal review. As always, our goal is to equip you with the tools and insights you need to confidently step into passive real estate investing as a limited partner. Reviewing real deals and asking critical questions is one of the best ways to sharpen your investing skills. Today, we have Chris Parrinello from Viking Capital, who's here to present their Avondale Commons deal. Joining me for the LP panel are expert LP investors Adam Cranmer and Litan Yahav to help break down everything you need to know about this deal. Here's a quick rundown of today's format. Chris will kick things off with a 15-minute overview of the deal. After that, Litan, Adam, and I will have about 15 minutes to ask follow-up questions, and then Chris will sign off and the LP panel will dig into our own discussion and analysis of the deal. As always, passive investing requires active evaluation. Our goal is to give you a peek behind the curtain on how experienced LPs think about these opportunities. Let's dig in. All right, Chris, welcome to the show. Why don't you tell us a little bit about Avondale Commons, Viking Capital's new deal?
Thanks, Paul. Happy to be here and excited to share this opportunity with you all. Avondale Commons, it's in Phoenix, Arizona, 324 units. It was just recently developed. Next slide is going to talk about the developer a little bit. Overland Group, it's headed up by Michael Holman. This is an interesting deal, and I'm really excited to kind of go into some of the nuance. But just before we begin, this is a deal where another equity group and Michael Holman capitalized this project, built it, and Viking Capital is coming in a recap situation to take over the property, create a really great path for the existing equity in the deal, and create really great risk-adjusted returns for all the folks that participate. So that being said, I'm going to go through the presentation and kind of lay out how all of this works. Overland Group, really strong track record. They're headquartered in Salt Lake City. They've done a lot of properties in the Phoenix MSA and in Utah. You can see 175 million assets under management, really strong assets under construction. Their pipeline's robust. Now, this is Edward Menarchik, who is our director of asset management. But as Viking Capital transitions into having a development vertical, we really brought Ed on to do both. He has done personally in roles with other companies, over 7,100 units, over $1 billion of assets constructed and developed. And he's the person on our team that's really keeping the other development partners that we have in development deals and in this deal that's finishing construction now honest and using his background and track record to protect Viking and our LP's equity. Briefly on Viking Capital, we started our firm in 2015, humble beginnings. For those of you who don't know Viking, I think a lot of folks in this network probably have heard of us. Vikram Raya and Ravi Gupta are our two principals. They started this company. They were both physicians, and they started out, very humbly, doing small properties themselves, partnering with bigger sponsors, getting to the point where they were JVing with bigger sponsors, and then started doing their own deals. So you can see our growth trajectory around 2020, 2021, in those COVID years where there was a really strong appetite for multifamily, compressing cap rate environment. Viking really grew. And then through some of that adversity and on into 2025, it's just been steady growth. Now we get into 2025 and we have started a development deal not too far away from this property in Peoria, Arizona. And that's really how we got this deal. So Michael Holman is our development partner. And this came to us off market because he was the one that built this. And there was a way for us to come in and really help out the original equity and create a win-win for everybody. This is exits and performance. I'm going to kind of gloss over this, not because it's not important, but this is going to be included in materials should you have interest. The caveat I always like to give here with our investors when I'm chatting with them is it is worth noting. You can see our latest exit date is 2022. These numbers are going to look phenomenal because we exited at the right time. It's not necessarily indicative of where every property in our portfolio is, but I think it's always worth mentioning because it's not necessarily true that these strong average annual returns and IRRs are going to exist as you exit into different parts of the real estate cycle. I think it's important to be transparent about that. These are some of the current properties just to give you a snapshot of our portfolio. and the list of the just over 1 billion properties that we've transacted on, including the disposed of properties and the ones that are currently in our portfolio. So now into Avondale Commons. I really liked this deal. It had a tough time making it through our investment committee because the idea of doing a recap and putting, the idea of maybe putting good money after bad, how is this going to work? How do we protect our LPs? There was a lot to kind of talk about in this deal and a lot of negotiations with the current equity and the developer. What we loved about this deal, taking that piece away, is its location. While it does have some challenges with a bunch of new supply coming online in that area, that is really a benefit for us because we're buying a 5-year window to get this stabilized and ready for the NOI growth that we need to sell at the cap rate that we want to sell at. You'll notice as we go through the presentation, it's surrounded by healthcare centers. So the ed and med environment in this area is really strong. And there's a reason why all of these institutional players decided to develop here. So really excited about the location, really excited about the partners that we have in this deal. We were pretty pumped to add another deal 10 miles away from the development project that we have. Property summary, I'm going to gloss over this one. You guys can look at this when you're going through the deal and going through the model. But you can see it's a larger property and, it's not quite finished being built. Offering summary, purchase price, 122, close to 123 million. The debt, which will take a little bit more explaining either through a follow-up call. But, with this being a recap, this is the new debt that's going on the deal. The total equity, including what Viking's bringing, which is this 25.5 million, is 55,760,000. And the price per unit right around 380,000. You'll notice in other parts of this presentation that Viking's actual basis is quite a bit lower. The overall investment offering, and for folks that know Viking, we break our offerings into 3 structures typically. There's usually a class A, a B, what we call reserve class, which is really just a higher investment amount. Class A doesn't work on this one because even though this isn't a traditional development deal, it is a deal that's not stabilized. It has several months for construction to be completed. So distributions do exist, unlike a traditional development deal, but they start at the beginning of 2026. And we got rid of that 10% cash on cash class that we typically have because of the structure of this deal didn't support it. This is the new loan information, 67.2 million, interest rate at 7.5%. One of the things that I really liked about the debt that we're in conversations with the lender to close on is that the floor is pretty low. So it's going to be a spread above SOFR. So I think right now it's 7.5 if you look at SOFR today plus a spread, but the floor is down to 3% plus a SOFR of 3%. So there is some room here if rates come down for this deal to get a little bit more attractive. Of course, we didn't model that out. This is the development timeline. So, and you can see with this hashed orange line through the middle of this graph to the left is what happened starting in 2022, the groundbreaking, when they raised the equity, when construction began. Now we're in July of 2025. We're weeks away from the first delivery of units, and we're raising this 25.75 million of equity to help support this project, get it through stabilization, fully leased up, and into a better cap rate environment to exit into. Plan is to have an 18-month stabilization period and exit this as early as, probably 3-4 years from now, with a total hold period expected to be 5 years. So here is kind of how we talk about Viking's basis, the original equity that's in the deal. How does this all work? So here on the left, you have the original structure, 30.25 million of equity. They had 4.5 million of preferred equity that they added into that and the original debt. Now, Viking's coming in with 25.755 million of equity. And it's really right-sizing the existing loan structure. So the new debt is going to be 67.2 million. And then Viking's going to have its equity in the deal. This existing and pref equity will be completely taken out of the deal. And then the existing equity of 30.25 million is staying in the deal and at a less preferred position than the new equity that's coming in, which is, I think obvious of what would need to happen to make this work. So to go kind of through what that waterfall looks like, the debt would need to be repaid first. Then all profits would go to Viking and its LPs until Viking has a return of its equity and a 10% IRR. Assuming that there is more, which we've modeled it out to this 18% for Viking investors, you would have 100% of the profits going to the existing equity. This is how we try to make it equitable for the 30 million of folks that were still in the deal, to give them a pathway to not lose any capital. Because today they probably would have lost half their capital if they didn't add this tranche in. Once they are made whole, then all of the additional proceeds go to Viking in a favorable split, 75% to Viking, 25% to the original equity. This is a kind of a snapshot of the pro forma. This is what I tell our investors when I'm doing this webinar to our existing base is, this is really a snapshot. We're happy to share our model. I'm happy to go through it with any of you who are interested in this deal. This one's a little bit more complex than a typical acquisition that we would do. And then, of course, I always record a pro forma video where I go through everything for folks that don't have time to sit down with me for an hour and a half and go through the model. So just reach out to our team. We'll get it to you. This is a breakout of what a $100,000 Class B investor versus a $500,000 reserve class investor would look like. It breaks out the cash flow. Reminder that this starts in January of 2026 and then would go on from there. A little bit of a sensitivity analysis. I'll let you look at this at your own time, but it's really hard to have a crystal ball to know exactly where cap rates are. A little justification on this number is, I think if this property had to be sold today with the class it is, in the area it is, assuming it was fully stabilized, probably sell at around a 5 cap. We are kind of baking in with our base case, 50 basis points of compression for this type of product that we know institutions are going to be looking at, and given 5 years to get that compression. We talked about why I love this deal, but a couple of the big things we love is the market, the economies of scale, high demand and limited supply. A lot of supplies come on in the area, but I think what's really important for deals that are going through stabilization and or development deals is there's very little supply in the pipeline that's getting built right now. It was the thesis for our development deal in Peoria. It rings true to this one as well. I wouldn't want to be in this deal and have to sell it today, but a 5-year runway, we don't feel like there's a lot of supply coming online in the next 2 to 3 years. And we verified that with looking at permitting and really what is going to happen. So a lot of these properties are going to have the runway to really get stabilized and create good exits for people that have the time. This is some specific unit mix data for the property. You can see it's a concentration of 1 and 2 bedrooms. There are a handful of 3 2s and 2 2.5s and 3 2.5s. The entire property is surrounded by townhomes. Those are going to be the first to get leased up. Those are these bigger units. So 2-story townhomes with garages. And then there's more of your typical modular style, garden style multifamily in the middle with the amenities and all that. Here's a layout. You can kind of see how the property's laid out, where the amenity areas are. You can kind of see what I mean. These back areas, bigger units, are those townhome units. This is also part of a broader mixed use development that the developer is also going to be putting some of this stuff on the front end of this property. A lot of this is demographic info. I don't want to gloss over it, but I think this is stuff that when you get the model to review and you get the deck to review, you'll be able to go through and see the economic demand drivers. These are really in every deck for every deal that you look at, but I think they are important. As far as rent comps go, we were kind of right in the middle. I think that we recently onboarded a new property management company, Pegasus, for our entire portfolio. We moved off of Asset Living. And they spent a lot of time with us going property by property and really diving into these numbers, helping us figure out exactly how long it was going to take to stabilize given the new supply coming online. And I think we're in a pretty good position given the market. One of the reasons that this property is, in our estimation, really solid is Viking's basis. So Viking's basis, in order to get its capital back, is like $92 million. Pretty unheard of for a brand new deal. Now it's because of the structure that we employed, and we have that 30 million of equity. It's almost like a zero interest loan sitting in front of us. I think they have a solid way to get their principal back. But in a downside scenario where this property had to sell tomorrow, it's most likely not selling for 30 million under the price to construct. Now, obviously, we're not going to sell this property tomorrow. We're restructuring the debt. We're going to have several years, up to 5 years, to really engineer the right time to exit this. But this is one of the more risk-averse deals that I've seen that Viking has done, to have this built in with that equity in front of us. These are some growth catalysts, some metrics for the area, Avondale specifically. The area is really growing. It's what attracted all the institutions in developing all this multifamily. We do need to have the runway for all of this to get absorbed and concessions to burn off. But the market is one of the strong parts of this deal. You'll be able to see the different medical centers that are kind of built around this property. And the rest is just demographic data on Phoenix in general. So I'll let you kind of look at this on your own time and open up to the rest of the presentation.
Chris, really appreciate the condensed commentary around this deal. I know it's difficult to get it all out in a 10 to 15 minute time period, but I think you did a great job. I'm going to kick the panel off here and talk a little bit about the market. You alluded to the supply glut that Phoenix has experienced over the last couple of years with all the properties that have been delivered. I was reading the Q1 Matthews market report. Matthews, for those that don't know, is a commercial real estate broker, one of the larger ones in the country. And they remarked that 23,000 units were under development, which represents about 5.5% of the total inventory in Phoenix. And that puts Phoenix at the 6th spot for the most aggressively built apartment markets in the country. Right now, vacancy is at 11.9% and expected to rise. So while the pro forma does show that it's going to take some time to stabilize, which I think is fair, and you guys have obviously thought this through in talking with a lot of property management companies and internally about how you're going to deal with this. As an investor, how can we be confident amid such a apparent oversupply period? And do you guys have any counter data to suggest that maybe what I'm sharing here is not to be concerned about?
No, I mean, I think that is one of the major risk factors. So I think the data that you're reporting is probably accurate. And we have kind of built our thesis around this isn't going to get worse. It's going to take some time, but it's going to get better. The properties that are under development now are getting completed. Like, this is one of those properties that's in that data. And that subset of property is going to face a challenging time getting absorption. Like our Peoria property, we plan to have that fully absorbed in 12 months. We added an extra half a year to get this one there. And we built in a robust concession strategy to attract folks to this property as opposed to other properties. But that is one of the challenges. And that's one of the reasons why we model this out to a 5-year window and not a 3-year window. Is the only thing that's going to solve for that is folks to stop building and give time to absorb. It's not that the product type's bad. It's not that people don't want to live here. It's just going to take some time. And what's encouraging is if you look at the data on new starts or entitlements that are getting through in this area over the next 6 to 12 months, that's where you're going to see things go more like this. We're not going to get hit by a bunch of supply today, like we are, and get hit by even more supply 2 years down the road. It's going to be more of an immediate problem that we have a plan to work around.
Understood. Litan, let's kick it over to you.
Yeah, Chris, thank you so much. I'll be honest, this is the first presentation I've seen of you guys. And I think that it's interesting because when I saw the deck in the email that Chris sent us, and I was like, oh, damn, this is going to be such a salesy presentation, all these like nice graphics and so much design that went into it. And I really love how you presented it in a really like authentic manner, and even answering Paul's like hard question. Yeah, that is a risk factor. And I think LPs really appreciate that, no bullshit approach. Yeah, in your face. So I appreciate that.
Thank you.
And thank you. And I have a different approach to Viking after hearing you present it. I do have some questions, and I have a lot of questions, but I'm just going to ask one, and I'm going to hand it over back to Paul so he can switch gears because he likes to do that. In terms of fees, so I went through the PPM and the operating agreement. There's a lot of different fees in there, and I'd appreciate sort of you if you can also, touch on that in terms of this deal because it is convoluted.
Yeah, no, 100%. I appreciate your sentiment that you started with. And as you get to know Viking a little bit more, I've been with the company for about 3 years. And when I was brought in, like one of the things that I wanted to change but emphasize is I didn't love the marketing salesy approach. It's like the opposite of who I am as a person. So the agreement that I made company-wide is, yes, marketing is extremely important, especially with the feedback loop. Things need to be beautiful and well done, and we should invest in that. But that is like watching a commercial on TV, and like the product still has to be really good in order for this to make sense. And we also need to make sure that investors coming in understand what they're investing in. So like the watching a webinar like this is always like the very superficial first step. And we expect every investor to work with us to go through the model and understand all of this. And that's where the fees would be, clearly marked. We don't put it in the webinar, but it's explained in the performer review. This deal is also a little bit unique. There's like a stated purchase price. There's like the actual value of this property, and it would have been easy. The way Viking typically does it is there's a 2.85% acquisition fee on the purchase price. And there's also usually a 0.15% sponsorship fee that gets added into that. So really 3% acquisition fee. This property was so large, and it's a recap, that charging a 3% fee on $95 million would have been excessive in our eyes, and it would have hurt the deal mechanics. So we lowered that to something, I think it's like 2.15%. I'll have the model right in front of me. But the way it shakes out is the acquisition fee is limited to $200,000. There's also a fee that the original sponsor had in of $750,000 that is more of like a development fee that Viking's taking half of. But that's how the fee structure for this deal would work, and really what Viking typically does on every deal.
Just to clarify, the PPM talks about $2 million acquisition fee, not $200,000.
$2 million is the it's like 2.1 or 2.25% of our basis. Yeah.
All right. I have a bunch of questions, but I appreciate you talking about that.
Of course.
We'll get back to you, Litan. Adam, let's go to you.
Thank you, Chris, for that presentation. It was nice and enlightening to kind of see the levity that you brought to, a tough situation that is Phoenix. I thought about bringing in my son's stuffed elephant here. So we had an elephant in the room here of Phoenix's supply glut. So obviously, Paul hit us there at the very beginning to talk about the supply in Phoenix. In particular, I'd like to tie that conversation that you just had without rehashing it. But I think in your pro forma, your average rent increase is about 3.6% across the 5 years. I don't know the breakout by year, but essentially it's 3.6 on average. Interesting thing for me is that expenses are about 2% across the board, with 1 year actually decreasing. I think it had to do with promotions and marketing and things like that. But can you kind of talk to that? Are you optimistic those will be hit, considering, I'm a Florida investor. We are not seeing rent increases much at all, and our expense increases are double digits minimal, for across the board. Can you speak a little bit to that, please?
For folks that really want an in-depth answer to that, I think our asset management and development team are going to be able to give kind of a better rendition. But this is really going to be based off of what they have worked with the property management company to kind of engineer out. When it comes to the rent growth, I think the powerful part of this deal and where things are going to become valuable for the exit is that you're kind of getting it at a lower basis and you're getting it pre-stabilized. And a lot of that rent growth is getting it fully stabilized and burning off the concessions. I think we modeled it out to have a lot of that stuff built in, even though, our goal is to not have to utilize all of that.
Makes sense. I want to ask a question regarding the partnership, Chris, and just understanding how the Overland Group fits into the overall capital stack. There was some language used in the PPM and then in the pitch deck. I want to make sure I'm matching it up correctly. So I'll just do a few questions here and break them out. Class D is mentioned. Is Class D Overland? Is that the existing equity of 30 million and change?
No. So Class D is kind of a brainchild of mine for Viking. So we don't put it in our decks. It's not something that we advertise, but it's essentially the highest equity split that we would offer. And originally what this was used for was like an institutional group. Like somebody came in and wanted to write a $10 million check. This was essentially the most Viking would give away for a large sum of money. Once our portfolio started to hit a little bit of adversity, because one thing to be transparent about, I think anyone in real estate knows, deals that were bought in 21 and 22, potentially with variable rate loans, kind of hanging on for dear life, and Viking's not immune to that. We didn't have huge exposure like some other groups. We didn't lose capital yet, knock on wood, but we did have a lot of investors that were feeling like their expectations weren't met. And I wanted to find a way to solve that. So I asked the principals if I could engineer an idea and put it on their desk for approval. And I got it approved. And that was Class D. So the idea would be, if anyone that is in a Viking deal, if we missed expectations, we told you were going to be getting distributions in our model and we're not hitting that, then if you continue to give us an opportunity to rebuild trust with you, then you no longer use these normal shares. You get to go into Class D and get on this deal, it's a 95-5 split. It's usually 90-10. So basically Viking giving up a huge portion of its promote to people that we should honestly be looking for ways to build more trust with, not try to make the most money on every deal.
Okay. That clears up some of my confusion. One more question about the partnership, and I'll shift it over to you guys again, Adam and Litan. I believe that Overland is referred to in the PPM as quote unquote the landowner. Is that right?
Correct.
So in a circumstance where you had to sell the property, earlier than expected, or today, as you referenced during your presentation, the equity there might be impacted or wiped out potentially, but Viking's capital would still be intact. Does the landowner, the developer, have that equity? Do they have the rights, or do they need to sign off as to when the deal can be sold?
We did keep this to where, Viking's going to be in control of the transaction, but this isn't a predatory play where Viking's trying to get its principal back in a 10% return. Like what you see with like some preferred equity groups, and Viking's worked with them. It's tough where they have an outcome that gets them everything they wanted, and the other equity in the deal is just out of luck. And they're not interested in holding the deal for 3 more years because they've already gotten what they were planning to get. We wanted to avoid that. So when we were structuring this conversation with the original equity, with the developer, which is Overland Group, we wanted to find like a real equitable situation where Viking wasn't being greedy. Our investors were incentivized to participate because this deal is a different structure. But there was actually a likely scenario where all of the 30 million of equity gets recovered. Like our end state is making more than a 10% IRR. But really, like I've talked to a lot of those investors who are interested in investing in this deal. Like they love that somebody has come in and said, we're going to help you. And it was important to actually make this a partnership. So is Viking in control of when we sell? Yes. But it isn't a situation where we're ever going to like take away the chance for the original equity to recoup their capital. It's really important to us that they have a good experience here too.
Can I push on that one a little bit? So understand the desire for kind of equitability and being a good partner here. But I think at some point, the market does have to feel a little bit of pain, right? If you make a poor investment decision, I think you kind of get to suffer the consequences. Unfortunately, that's how capitalism works. Because the first couple of years on this deal are significantly low cash flow, 3-4%, right? In those first couple of years, I wonder if there wasn't enough pain felt by those existing equity members that you're not putting them ahead of us in the capital stack. There is that cutoff. I really appreciate the funnel. That was one of my biggest questions here. There's a cutoff at 10% where that shifts directly back to that equity team. So we're reducing their pain with the goal of them hitting all of their equity return, right? No return, but getting your equity back. Speak a little bit more to me about that, of like why we as the new investors here should take a little bit lower cash flow in order to kind of be nice, if you will, to the existing equity folks that didn't make the best decision. I understand Phoenix was tough. Nobody expected Phoenix to happen the way it happened. I have good friends that lost the entirety of their deals. Can you give me a little bit more on that, please?
It isn't just from the goodness of our heart, right? We also needed to stay competitive with their other options. And their other options were to basically go bridge to bridge. We did the math. Like we worked with them on this. Like there was a lot of conversations because originally this deal didn't pass our investment committee and we needed to figure out how to make it attractive enough for our investors. The reality was if they were to not take our deal, they would probably have to bake in right now 20 to 30% of lost principal. So if we weren't giving them a way to do significantly better than that, then it'd be better for those equity investors to just assume that they're going to lose a small portion, but not make this more convoluted, not have another group come in and try to gain off of this investment. And if things go right, maybe they still recoup all of their investment. So for Viking, the big thing was we wanted there to be almost no chance. And I think that we've engineered that. Like tomorrow, if it sold, like worst case scenario, you're getting your principal back and not a 10% annualized return, but a 10% IRR. So if this deal's held for 5 years, that 10% IRR is going to be more than a 10% average annual return because once you factor in the time value of money. So it would be a little bit higher. I think in most deals we've looked at today, like at the market, like if you can get a 10 to 12% IRR, you're probably doing that deal if your equity will agree. Now, it's nice to have a 15% IRR or a 17% IRR, and like we'll show numbers that how we can get there. But when you watch the performer review and we go through the sensitivity tables, where the market is right now is like a 12 to 13% IRR, or there's some funny business going on, or like you're just getting the deal of the century that nobody could find. So we thought that like relatively low risk compared to anything else we could find, and a 10% IRR, almost not, I hate guaranteed, but like very likely was fair to our LPs. We launched this deal several weeks ago. As I've talked to LPs, like they get it. And they're like, in this age where maybe some of them have lost a few $100,000 worth of equity, having something with this safety, even if they're giving up some higher returns in other deals, they like it because it gets a little bit challenging to get over the PTSD of losing money that you thought was going to double.
Yeah, that makes total sense. Thank you for explaining that.
Litan, what do you got?
I have a few questions. We'll just focus on one because I know probably Paul wants to switch gears. I'm going to keep on.
Why don't you do two, Litan? You've been very patient.
I'll do two. All right. So first one, in the deck, in the extended version of it, there was talk about mixed use of the whole complex. Is that still part of the deal?
It isn't part of the deal. It's a totally separate thing. It's just something that is going to lend to the growth of the area. So the developer's developing it, but those economics of that mixed use is not part of this deal.
They're just spinning off the apartment part of it and everything else they're keeping to themselves, basically.
Correct. The original investment was in developing the multifamily, not the multifamily and the mixed use.
Okay.
Is the rest of the project on track, Chris, as far as you know?
Yeah, as far as I know. I think they even have like tenants signed up. I think it's very much on track.
Got it. All right. That helps clarify that. And then second question, I love that you did share the track record, also full cycle deals and active deals. Can you touch a bit about the active deals? Like how are they performing at the moment? What's the situation? Because you mentioned you haven't, like touch wood, lost any investor money yet, but you don't have to dive deal by deal, just like overall.
I'll give kind of an overview and then I'll let you know like what Viking's done to address its adversity. Because Class D was the beginning, but it isn't the end. And I think that that's something that's really unique about our firm that I haven't really seen anywhere else. And I'll kind of break that down. So right now in our portfolio, you take away the deals that have exited, you're looking at, I think it's like 19 deals. 4 or 5 of those deals are facing a decent amount of adversity where distributions are stopped. And in some cases, we've had to do what was our versions of a capital call. We didn't want to do the traditional version of a capital call, which would have been go to all the equity and say, we need you to put in this much more money and you're not getting anything for it, but you might save your original equity. This was another situation where the principals were like, hey man, you came up with Class D. That seemed to work really well. Help us through this. What can we do if we're willing to give things up? What is that we could do to be as equitable to our investors as possible? And I said, great, give me 3 weeks. I'll come up with something. My plan was because we have been a group that's really kept our investor base engaged, we've been able to continue going. A lot of other groups did a couple capital calls, lost people's money. They haven't been able to stay active. So we created a debt fund called Hyro GP. And what that debt fund is doing is raising capital from existing investors that are in the deals that are going to take on the equity. And also it's open to anybody. This wasn't supposed to be 2 deal reviews, but I think it is important to kind of distinguish this. The way that it works is Viking has taken and earmarked 10% of its acquisition fee, its promote, and its dispo fee for every deal that it did last year. It's like 4 or 5. And every deal that it's going to do this year, it's going to amount to at least what we have under contract is 7 properties right now, including Avondale Commons and the development deal that we're going to be launching in 2 weeks. And it's going to do 2 additional deals. That cash flow from the fees, which amounts to about $1.1 million of Viking cash that would have been used for operations, is pledged to the fund. And that creates an 18% return and a 12% return for people that participate in Hyro GP. For investors that are in the capital call variety, so the deals that are getting funds from this are Viking Wealth Fund and Elevate 23. Viking Wealth Fund was 3 deals. Elevate 23 was 1. If those folks invest 50% of their original investment amount, they get the 18% cash flow and the almost 2x return from our promotes that are going to be realized. Those are projections, obviously, outside of the cash flow. That's already in hand. We are also going to use the 90% of those 8 properties. So all of Viking's profits are pledged to the fund. We'd make $0 for the last 2 years of work. And that would backfill their original investment and the $11 million in Hyro GP. We wanted to avoid the good money after bad conversation. So we were taking away any way we can think of for folks to lose money. We're giving them great cash flow. And many of them, like we raised like almost $5.5 million of the 11 million needed from the existing base. And we also have a few million from other people that are just like, well, I want the good cash flow. Do I have to be in one of these deals? And the answer was no. We'll allow anybody to come into it. We didn't really market it. We marketed it to our internal base. And then we marketed it to all of the people who were like, look, like, we don't want to hide this. This is a capital call. This is our version. We're not going to say we've never done a capital call because this is a capital call. However, this was a way for us to take almost the way it shakes out in the model is about $7 to $8 million guaranteed of Viking profits and pledge it to the mistakes that we made in the past. And then you also have about a $30 to $40 million projected backstop to protect the higher GP funds and the original investors that were in those deals. So the answer is yes. We have some deals that are challenging, and we have some deals that we can look back, and I've called a lot of these investors. We've done webinars, taking accountability. Like, we got it wrong. Our underwriting was wrong. We were way off. We didn't think rates were going to rise the way they did. We shouldn't have used variable rate debt. This is why we thought it was a good idea. We got caught in the game of musical chairs. But now we're going to do what we think is the right thing, which is take future profits and right-size those issues. And all of that came to me as an idea because one investor called me and he said, Chris, I'm really upset. My deal's not paying distributions. You guys are out buying all these other deals. How does that help me? And this was a way to make that work, make people say, well, I'll participate in those deals because your success is actually my success. And that's been a very successful program. And we can detail all the challenges on all the deals we have if people want to call, but we're very transparent about that.
Yeah, that's super helpful. I appreciate it. Good luck explaining that to an investor. I understand that's like a whole effort on its own, but I think it's really interesting solution.
There's lots of graphs.
This has been a unique deal review in that we haven't talked as much about the deal, but we have learned a lot more about philosophically who Viking is. So I think we appreciate that, Chris, and the transparency. Adam, do you have any other questions?
If we have time, I certainly can. Maybe it's fitting if this is our last one, but I'd love to know a little bit about the exit strategy, like going back to the deal. I know the play seemed to be, from what I could tell, is to sell to an institutional buyer. Are there things within your wheelhouse that lean you more into institutional? Was it built a certain way that invites more institutional folks to come along in a kind of supply glut market, knowing about the great employers and everything else that's coming? Any secret sauce there on the exit?
It's not so much a secret sauce. I think the majority of the new supply that's coming online in this area and the value of these properties, assuming the market trends the way we see it going, take out your mid-size groups. To buy a $140 million deal, it's not usually going to be a group that has 500 investors syndicating a deal. The other thing that we really liked about pairing this deal with the Peoria is the time horizons kind of match. So Peoria is going to be completed in 3 years. Now we have 2 years of leeway in that loan structure. So we're like, okay, like we have 5 years in this one, we have 5 years in this one. There'd be a really nice play here to take two assets that were built in 25 that are 10 miles away from each other and attract an institution that way. But yeah, I think it's probably the most likely scenario. Where I think there's probably a little bit of risk, which I think it's worth noting, is we're baking in 50 basis points of compression to today, and that's a no-no. Like, there's no way around it. Like, typically, like, you're supposed to extrapolate out and say, I want 100 basis points the other way. But if you do that and you don't have faith in the fundamentals, then you're never going to find a deal that works. So we disclose it. We talk investors through it. We explain to them how we got there, why we think cap rates are compressed 50 basis points. And we tell them, if you don't think that's going to happen, this isn't the deal for you. But if you want to take a swing and you think this is going to happen, that's how we're going to get to that 18%. We just feel like we've created really good safety around the base case of not getting the 18%.
Yeah, I appreciate the transparency there. And obviously you're very willing and open to speak about the risks, right? One of us was going to ask about the cap rate, and I don't think we had time to do it, but thank you for calling that out.
It should be
everyone's question.
I'm just curious about who the property manager is on this project. You guys have in-house, you vertically integrated, or is it third party? And if it is third party, have you worked with them before? And do you have confidence that they can help through this kind of overabsorbed or oversupplied market, I should say?
Yeah. So we had for many years used a company called First Communities Management. We had a really strong relationship with them. They built a team within their team. We felt like we were vertically integrated. The partnership was so strong. Unfortunately, last year, they were acquired by Asset Living. And we went into that new partnership thinking everything was going to be fine, but trust and verify. And we were pretty clear that what was important to us was the relationship. So when our regionals started disappearing, or when property managers started leaving, and groups that we had a lot of trust in and relationships with were like, we don't want to work for this company, huge red flag. And in the last couple of years, we had brought on Edmund Archik, who we started the conversation about, our asset manager, and he had worked with Pegasus for 15 years, multiple firms. He knows the CEO and the COO personally, really strong relationship, lots of trust there. So it's kind of a no-brainer when we wanted to make a switch to bring them on to manage our entire portfolio. So we brought all 6,500 units to them, minus we have one property in DC where, because of landlord and tenant laws in DC, we just had to go with someone that's DC based that really knows that market really well. Third party's been great for us, kind of because what we just saw. Like, we weren't happy with what was happening. Our properties were suffering when every property was suffering, but more so than we thought was necessary. And we were able to move off of them, bring someone else in. And now that person lowered the cost to us to get all of our units and has SWAT teams at every one of our properties cleaning things up because they love the idea of getting 6,500 units of business. You don't want to change property management companies every day, but you do have the ability to pivot when you're not vertically integrated. And Viking would love to vertically integrate one day, but where we're kind of in our 10-year plan is when we get to the next cycle where we can exit some of the 20 some odd properties we have, and that compounds and we go from 1 billion of acquisitions to 3 to 5 billion, and we have 15,000 units under management. At that point, it will make sense for us to hire the several hundred people it takes to vertically integrate.
Makes sense. Well, Chris, this has been very insightful. Appreciate you coming on to the show and sharing this deal and being so transparent too. It's been great.
Yeah, thanks for having me. This has been fantastic.
Thanks a lot.
All right. We aren't here to make any recommendations. As a reminder, we are here to provide additional insights to the opportunity. But if you're considering investing, we strongly recommend you make your own conclusions. That was a great deal review. We talked a little bit about the deal, but we really got to know Viking, I think, a lot more there too. Litan, you were as nice as I've seen you on one of these shows. What's going on?
I mean, listen, I love people that are transparent and direct and honest. And I just really felt that from this guy. Chris was, you shot him some hard questions and he just, it's the risk. I mean, not sugarcoating it. And I will be honest, when I went over this deck, this was the most worked on deck that I've ever seen. And I guess I haven't seen a lot of Viking deals, but like, I felt like I was looking at an advertising company's deck with like these big logos. And I was like, oh, damn, this is going to be such a sales guy. And I was just like so happy to see that. And I guess that's why it was like just so, I prepared myself to be, aggressive and I didn't. Anyway, I liked that. So that's about Chris. I thought that was really refreshing and it really helped me feel more confident and understand. Yeah, that's my 2 cents, just to recap it.
I would agree. It's very disarming, and it was a different deal review than we've had in the past. Adam, if you had any additional questions to ask, what would you have asked? It's tough to get them all out on a show that's this length, but was there stuff that you left in the tank there?
Yeah, the big one, obviously, we talked a little bit about at the end was the cap rate, and particularly on the exit side of the house. But if you look at their sensitivity analysis, it's with kind of 10 bips, right? It's 4.5 to 4.4 to 4.3. You don't get to see any of the where do we go into the red here. I certainly want to kind of have them walk me through that and kind of ask a blunt question as to say, these are really small movements within a cap rate. It's interesting to me that among this incredible marketing presentation that you put together, that there was not kind of more of cap rates jump by 25 basis, 50 basis, 75 basis, and you guys are taking these in little 10 increments. Was that purposeful in the display of that? How do you truly believe that you're going to get to a 4.5 cap rate when you're suggesting that it's at 5 today and you're buying it at, don't quote me, 21%, 28% under construction cost? I would just want to dig into that. I mean, I've got a lot of questions that I want to truly ask the asset manager, but that was one that I think Chris could handle well because of the fact that he was philosophical, but in a good way about Viking. And I think he could kind of give me a little bit more of the warm and fuzzies on that.
Yeah, he did say that Viking will show you how they got to their projections and they'll be upfront as to where they've been aggressive. In today's market, you can really expect a 12 or a 13 IRR. And if it's above that, somebody's pressing the gas or being aggressive in some regard when it comes to the inputs on the spreadsheet. So he's not letting us kind of find those things out himself and then call them out. He's calling it out before we even get the chance to and saying, this is how we approach it. So get comfortable with the risk or don't invest, is I think what he said. Litan, how about you? Anything that you would have asked that you didn't get to?
Not really. I asked everything I wanted to ask him, but I do want to say something just about what Adam, what you said on the call about the seller should suffer. I agree with that, generally speaking. I have no problem with that. I agree. I think, bad deals need to pay their dues. But just based on what you just said, even Paul, if we're thinking realistically about this as a multifamily value add type play, because there is a developing concept, but it's already basically built. There's more risk involved. So let's just say their projections are aggressive and this is like 13%, 14% IRR. Their investors are not going to make a lot of money. Like if they're only getting paid after 10% IRR to us, then they're not going to lose money, but they're also not going to make money. Like that's basically inflation, right? So I'm just saying, like, I look at this as it is a distressed deal. There's no doubt. It's solved creatively. And it's a pref equity deal. Like it's not presented as such, like in your face, but it is. You're basically getting pref equity. And that's what the market is seeing a lot of at the moment, a lot of pref equity deals.
Pref equity with the potential for upside. That would be my question that I didn't really get to ask, was that funnel that he showed where he described the waterfall, that was not included in the pitch deck. So that was the first time we were all seeing it. And then I'd have to go back to the PPM just to make sure that I didn't miss something. But I feel like the waterfall that he explained differed from what was in the documents. I don't know if you guys felt that same way or not, but maybe the deal kind of evolved and we've got an old set of documents to look at. But the way that he described it, it sounds a lot more like pref equity with potential upside. The way that it was described, as I read it anyways, and again, I'm not saying this is fact. I could have made an error as far as how I interpreted it. It did not look as much like pref equity.
Here's the thing, right? I mean, at the end of the way I see it, maybe I'm overreaching on this. The documents that they share, the PPM, subscription docs, and operating agreement, are for their investors. There's another agreement between them and the seller. That agreement wasn't shared. Now, maybe it's good to share that as well so we can see like what's actually happening under the hood of the agreement between them, because it does affect, us after the fact. And that is not, and I don't know if they have to show it in the PPM and subscription docs because, it's the deal.
That's their operating agreement between the two of them. And that spoke to my question about, do they have control rights? Are they going to be able to say, hey, no, we're not selling right now, or we need to sell right now, or have any sort of those provisions as far as refinancing or anything? So
it is a great question that we should have asked now that you mentioned it, because you asked about Class D. Is that what they get? What shares do they own in this deal? And that's the biggest question, I guess, based on what we're talking about now. What is it? There are partners as well, but it's not listed on the operating agreement or on the subscription docs, and then we need to know. So I guess that's a great question.
So I wouldn't call that a red flag, right? That's just, hey, we need to understand this a little bit better. Maybe we didn't have time to dig into it as much as we'd like to. But are there any red flags, so to speak, putting that particular question aside?
Well, there's the risks that we all talked about. And I wouldn't say them red flags, it's just risks. He did try to sort of position this, and I kind of understand why it has like a low risk deal. It has maybe low risks to some extent that are more conventional in what we look at multifamily, but other risks and others. And so, if you ask for red, I don't know, this isn't a red flag, but for me, I think the risks aren't worth 10%. I think they should be worth more. But again, we'll talk about this at the end, but that's not a red flag, but just something to pay attention to.
I agree there. I didn't see anything that was red flag, which I feared going into this as a Phoenix deal, right? I joked about my son's elephant, right? It didn't seem there was anything fundamentally wrong with the deal. I think I disagree that Phoenix is in that place where it can withstand an investment like this at 11% vacancy, but I don't think it's a red flag. I think it's just a risk. And I know we're going to talk about this here shortly, but I agree with you that the risk to reward is pretty high for me to get 10%. And I really want to dig into making sure, and maybe this is a red flag, making sure that these side agreements that they've made with the developer, et cetera, are part of this deal, that everything is located within this deal, within the actual legal PPM, OM, et cetera, that those are put into there, because it's certainly not done purposefully, but I want to make sure that all of those things are listed out. Who has control, who can do what, when does the money go where as part of the waterfall? Because Paul, like you said, I didn't see that part of go to 10, push equity their way, go up when you get to 18, then you get to re-engage in the deal. No real red flags for me, but overall.
Well, also one thing we didn't ask, and also this is in the I don't remember if it's subscription docs or operating agreement, but there's hurdles here in terms of the waterfall. Right? There's a 50% hurdle above 18%. I think, I don't remember what it was. If it was above there was a hurdle, and it's noted in the docs, but it's also not talked about in the presentation.
Yeah, those are good call outs. Definitely things to dig into a little bit more. In the sake of time, I'm going to jump ahead. Adam, let's start with you. If you had capital to invest today, would you?
I think I've showed my cards here. It's a no for me on this one. I don't truly believe in Phoenix yet. I am watching it closely. I think it is one of the kind of hot markets that's going to be there. I've never been an early investor. I do suffer the consequences of having a couple friends here that did invest in the Phoenix area and have lost all of their LP's money because of it at what I believe is no fault of their own. Sometimes things happen. The risk to reward ratio is not there for me. The structure makes me a little bit nervous, as I would want to lean into it. Again, not a red flag, but something that I would want to lean into with the group. Just overall, it sounds harsh to say, but I think you can press further on the existing equity to get a little bit better deal for the new investors. When you're only promising 3% cash, 4% cash, I'd want to kind of press a little bit there. And the idea of, well, they could just get bridge. Yeah, maybe. But this one's a no for me, Paul.
Understood. Litan, how about you? Same question.
Yeah, I mean, as well, I think this deal specifically, I'd probably pass on, and this just goes to say, Chris's merit and his, presentation of Viking. I definitely want to look at more deals of Viking, mainly because of like him and how he presented him and their track record. I think that this deal helped me better understand Viking as a whole and, Chris as one of their key employees specifically. And it just got me more bullish about them specifically, but about the specific deal, probably not.
You kind of took the words right out of my mouth, Litan. I feel the same way. I went into this recording thinking that I was an absolute no, and it has a lot to do with Phoenix before it does Viking. And I didn't even know about the trials and tribulations. I kind of assumed during the period that they were acquiring assets that they probably had some troubled ones, but I didn't know the details that Chris was so forthcoming about. And I really appreciated his candor and how his team is handling some of the challenges that they're facing. And I think that makes me more attracted to potentially looking at their future deals. This particular deal, I think I have some things that I maybe misunderstood coming into this recording that I would want to look at more closely after talking with Chris here today and understand myself a little bit better. And I wouldn't rule it out entirely, honestly, but I do tend to agree that the risk reward ratio is a bit off from a cash on cash potential upside standpoint. It's not there. I like that there's that 30 million in front of whoever does invest in this deal. That gives them some downside protection. I like that the Peoria development that they're working on right now could be packaged with this property a few years down the road and sold to an institution. 600 units, additional scale in a market for an institutional player. That's compelling. I don't know much about the submarket of Phoenix where this is being built. I haven't been down that way. I like Phoenix a lot just to hang out in, but I've also been to Phoenix, it was like 2010, 11, and we were driving out to the Grand Canyon and you see these developments that were finished, but no one lives out there. It's just empty. Like they overbuilt and then it gets absorbed eventually, and then it booms and rockets, and then it gets overbuilt. It's a very up and down market. So while it's attractive and if you hit it right, it can be a great investment as far as a market to invest in, it does have, a lot of volatility. So I think, to the point about absorbing the units that are there today and that are coming online, are we catching a falling knife? I don't know. I really don't. So those questions are what I would have left over as far as if I were going to evaluate this deal further. But I think Chris did a great job of highlighting Viking's philosophy, their approach, their commitment to their investors, being upfront about the challenges they've had, how they're addressing them. And for that reason, I think maybe in the future, I would consider investing.
One thing, Paul, I know I'm cutting this off, but I have never heard that type of structure for capital calls. And I think it's super interesting the way they approach it, because they're really trying to find a creative way to keep their investors whole, putting their hands in their own pockets. I just love the way it sounds. Super complex. Like I really think you need to understand it, but I wanted to just mention.
I agree. I mean, the fees they're charging on the debt fund that then they're putting back into the deals that are struggling is pretty cool. They're not really making money off of it. Would want to learn more about that, but I agree. And there's other operators out there that are doing capital calls. They're not calling them capital calls. They're disguising them as debt funds for maybe their own deals, maybe not. You don't know, and they don't say, but you kind of know what's going on, and it's not transparent at all, where these guys are calling it out. That's unique. Awesome, guys. That's a wrap. Thanks again.
Thanks for having us.
Thank you very much.
And that's a wrap on this deal review episode. A big thank you to Chris Parrinello from Viking Capital for walking us through their Avondale Commons deal, and to Litan Yahav and Adam Cranmer for joining us on the LP panel. We hope this gave you some useful insights into how limited partners evaluate deals and what kind of questions you should be asking before making any investment. Thanks for listening, and as always, happy investing.